Here is a thought that hit me while staring at my portfolio one night. Korea's stock market opens about 13 hours before New York. So if Samsung and SK Hynix surge on a Monday morning in Seoul, could I just buy Micron before Wall Street opens and catch the same wave? A free preview of the US session, 13 hours early. That question sent me down a rabbit hole. And what I found at the bottom did change how I see my portfolio, just not in the way I expected. It was actually worse. Let me be upfront about what this is. I did not run precise correlation math, so instead of inventing numbers, I traced real events and real price moves over the past 6 months. This is my personal observation. Not statistical analysis and definitely not financial advice. The idea started with something simple I kept noticing. I hold 2 KOSPI 200 covered call ETFs and I hold Micron shares. One is a Korean product, the other a US stock. And yet they turn red on the same days and green on the same days. Why would stocks listed in Seoul move in lockstep with one listed in New York? 3 structural reasons. First, these 3 basically are the market. Samsung, SK Hynix, and Micron control roughly 90% of global memory supply. Samsung around 36%, SK Hynix around 29%, Micron around 24%. When 3 companies are an entire industry, they all respond to the same variables: DRAM pricing, HBM demand, AI data center spending, Chinese capacity. Second, they sell nearly identical products: DRAM, NAND, and HBM. Good news for one is usually good news for all 3. Third, they reference each other on a time lag. Micron reports first, so its results read as a leading indicator, and that shows up in Korean shares the next day. And it runs the other way too, now more than ever. Zoom out over 6 months and the story is visual. From February through June, all 3 climbed together. Micron led, up roughly 100%, SK Hynix around 80, Samsung about 40. Then, June through August, all 3 fell together, converging back down. 2 things jump out. The shapes are strikingly similar. Same peak month, same reversal. But the amplitudes are wildly different. Micron doubled while Samsung gained 40%. Same direction, very different magnitude. Hold on to that because it matters later. There are days that look like open and shut proof. May 11 surging together. Memory broke away from the broader market on shortage news. The S&P 500 was flat, yet Micron rose 9% intraday. SK Hynix jumped over 11 and Samsung over 6. The index sat still while the memory 3 moved on their own. Late July, crashing together. My most painful stretch, when China's CXMT listed and exploded. Samsung fell over 13% and SK Hynix 14%. The KOSPI dropped more than 9% with circuit breakers on 2 straight days. Micron, same wave, had its worst month since 2005. Looks conclusive. Buy the wave off Seoul session, right? That is only half the picture. Here is the counterexample that kills my whole trading idea. On July 2nd, Micron fell about 5.5% on AI investment fears. The very next day, July 3rd, Samsung rose over 8% and SK Hynix surged nearly 11%. Micron dropped and Korea rose double digits the next session. Exactly backwards. Why? The reason was buried inside Micron's own earnings. Its report showed mobile revenue up 254% and automotive and robotics up 311%. A signal that on-device AI, self-driving cars and humanoid robots are becoming real memory markets. And those use many times more memory than an ordinary phone. The market read that as better news for Samsung and SK Hynix, the mobile DRAM leaders, than for Micron itself. Micron got weighed down by its own rich valuation, while the exact same earnings content became a catalyst for the 2 Korean firms. So my original question, can I buy Micron on Monday? After a strong Seoul session, the honest answer is no. Not reliably. The direction is usually similar, but you lose money on the days that usually breaks. And those days are not random. They happen precisely when company-specific factors override the sector story, which is exactly when the move is biggest. And there is a practical nail in the coffin. By the time Korea closes and US pre-market opens, the information is already public and priced in. SK Hynix's ADR now trades on the NASDAQ, so the gap between Seoul's close and New York's open closes faster than any retail investor can act. The inefficiency I dreamed of exploiting is already efficient. So they move together but not equally. They diverge on 4 axes. HBM competitiveness. SK Hynix leads, Samsung is catching up, Micron sits in its own spot. business mix. Samsung is not a pure memory play. It has foundry, phones, and appliances, which is why it rose less on the way up and gave back proportionally more on the way down. Valuation. Each ran up by a different amount. So identical news produces different reactions. Market factors. Currency, foreign flows, and index weightings differ by country. That is why SK Hynix routinely swings far more than Samsung on the same news. Its HBM concentration makes it the most sensitive to the cycle. Now here is the part that only matters if you invest from Korea, and it is the part I keep circling back to. When the KOSPI convulses on memory news, it is not a sector story here. It is a national one. Samsung and SK Hynix, with their preferred shares, make up over 60% of the entire KOSPI. So a bad night for Micron does not just hurt my Micron position. It can move Korea's whole index, drag down my covered call, ETFs net asset value, and shrink my monthly distribution. In fact, that is exactly why my July distribution fell 7.7%. The fund's asset base shrank during the sell-off. Think about the layers. An American holding Micron has a sector exposure. A Korean holding memory has a sector exposure, plus a national market exposure, plus a currency exposure, all wired to the same cycle. There is even a strange wrinkle when the one weakens during risk-off episodes, which often coincide with memory sell-offs. My dollar positions get a currency cushion, while my won positions do not. And this is the conclusion that actually matters, the one that has nothing to do with timing trades. My portfolio is far less diversified than I thought. 2 KOSPI 200 covered call ETFs, and Micron look like different products, in different countries, in different currencies. They are really 3 bets on one memory cycle. That is why my entire account turned blue in July. It was not diversification, it was duplication. And here is the trap I fell into. As a project manager who should know better, I built each position for its own reason. The Korean ETFs and QQQI for monthly income, Micron for AI growth. But reasons do not determine correlation. Underlying exposures do. And underneath, all 3 answer the same single question. How much memory does AI need next quarter? I thought I was running 3 work streams. I was running one 3 times. What to do about it is my next homework. But the honest first step is just recognizing it, because you cannot manage a concentration you have not noticed. So memory stock correlation is real but conditional. Sector-wide news moves all 3 nearly as one. Company-specific news splits them, sometimes violently, which makes front-running Micron off. Korea's session a strategy that works right up until the day it costs you, and that is usually the day the move is biggest. The more valuable insight was accidental. My portfolio's apparent diversification across 2 countries and 3 tickers is largely an illusion. Once more, this was a personal, qualitative observation, not a statistical analysis or investment advice. Correlations shift with time and market regime. Please do your own research. If you want to see what I actually do to fix this concentration, subscribe, because that is the next video. And tell me in the comments, have you ever discovered your own portfolio was duplication, dressed up as diversification? See you in the next one.